This is Richard Flax with our regular monthly update. As we head into the fourth quarter, we wanted to highlight some of the issues that we on the asset allocation team have been focused on. The first is duration. Should we be buying longer dated government bonds? On the positive side, bonds now look better value. Yields have risen and there are signs that inflation is decelerating as the global economy slows. We also believe that central banks are close to reaching a peak in terms of rate hikes and could start bringing down rates in the new year. On the negative side, however, inflation is still some way above the 2% target, and getting there could be tough. We still see some inflationary pressures. Labour markets are tight, while the oil price, at least until recently, has been rising. In places like the US, the economy has held up pretty well, suggesting that rates could stay higher for longer. Another consideration is that longer dated bonds are yielding less than shorter dated bonds in many countries. Normally, you'd expect the reverse. So if you think policy rates will stay high and inflation could be stubborn, then buying longer dated bonds could be premature. Another topic has been equities. Overall, equities have performed relatively well so far this year, but it's been quite concentrated. We've seen a steady re-rating of US equities, and there are some good reasons for this. Firstly, US stocks have historically shown faster growth and higher profitability, and in theory that should merit some sort of premium. It's partly a reflection of sector composition, with more exposure to large technology companies in the US. Secondly, the economic environment in the US has also held up better than in Europe, which is reflected in the performance of some of these US-focused businesses. The third topic we've been focused on is commodities, and specifically oil. We've already seen increased interest in energy stocks over the past few weeks as the oil price has risen. At the same time, rising oil prices feed into inflation, and we'd expect to see that potentially reflected in the coming months. Could this present an additional challenge for central banks and households as we head into winter? Finally, there's a broad array of other issues to consider, particularly around geopolitics. As investors, we need to address several questions, not just how these issues might develop, but when and if they could become relevant for financial markets. In recent years, we've noticed how market participants have ignored geopolitical issues for long periods, even as they potentially become more significant. That has the potential to cause periodic spikes in volatility, which is something we need to consider carefully when thinking about how best to construct our portfolios. Thank you very much for listening and look forward to speaking to you again soon.